Well, let's begin the Q&A video from the weekend's market outlook. And I am expecting a plumber to show up because one of my new installments is misbehaving this morning. So you may hear a doorbell behind me or a knock at the door. If you do, I'll pause the video and then I'll just come back to it. I don't want to have to edit that out. So just, letting you know, you may hear a knock at the door. Okay, question. Is it feasible for a retail investor to perform fundamental analysis as part of the investment process? Yes, it is. It is more a question of the type of fundamental analysis that you would perform. You would not do institutional analysis. And when I say institutional analysis, I'm talking about a 5-year or a 10-year cash flow, where you're going to forecast all the elements of the income statement, the balance sheet, the cash flow statement. You wouldn't do anything like that. But there are certain things that you would look at. You'd want a good understanding of the business model, how the company makes money, and you'd want to identify the 2 or 3 big drivers of growth and the 2 or 3 big risk factors to that particular company. Usually the lack of the drivers of growth are the risk factors, but there could be other things as well. The most common type of fundamental analysis done by a retail, or at least for retail investors, is relative analysis, where you look at a peer group of companies and you look at how well one company is doing versus all of the others. Because you may find a company that looks good and the price goes up, but it's not the best in class. That within its peer group, there is another one that would be better to be in. Even though it might have slightly higher valuation, it might have better growth potential and lower risk. So yes, it is feasible to perform fundamental analysis. Short beta has been a rough trade for sure. No kidding. At some point you got to give it up. And yesterday I did quite a bit to get as neutral as possible on that trade. And I'm going to give it I think a couple more hours. I don't know, but it has not been an easy trade at all. And I think at some point it has to come to terms with the economic backdrop. It always does. It has to come to terms with the economic backdrop. But when you are in a momentum-driven market, or anything that is under momentum, that is behavioral and not fundamental. And when something becomes behavioral, it's the crowd. You have to get a message through to the crowd, and the crowd is aware of the economic backdrop. But the thinking behind momentum is buy high, sell even higher. So it's a lot of buy and hope. And every headline, even if it's the same headline repeated every day, is a reason to make the market more expensive every single day. I just looked at the triple Qs. The trailing PE is over 40. On the trailing PE, 40 times for the NASDAQ 100. 40 times. If you want to continue to do the same kind of daily trading, just bear in mind Dubai is on the other side of the world. I am aware of that. Yes, I am. And it wouldn't really matter to me. Country is totally different from Canada, especially weather. Good. This is what I'm looking for. I'm not looking for moving from one place to another place that looks like this but just has a different address. Why not just stay here, right? Panama capital gains tax at 10%. Would be easy to get a visa. It's super easy to get a visa in Panama and Costa Rica. I am visiting those 2 cities in 7 weeks. Early September, I'll be in Central America, and then end of October, I'll be in Dubai. So yeah, I am looking into that. If you want to get tax in nearby, you have Belize. I've looked at Belize. Belize is got a funny little tax system going on. Here's what I have to do is whatever I do to separate myself from CRA, which is Canada Revenue Agency, I have to become a non-resident. Now, it's not enough just to leave the country and go to another country and say, aha, I'm no longer in Canada. I must become a resident of that particular country and then I can apply to CRA to take me off of their resident list. I'm no longer a resident of Canada, I'm a resident of another country. If I'm a non-resident, I'm still a resident as far as CRA is concerned, and I still have to pay tax. Belize has that little particularity there, that it is a tax haven for a non-resident. Then you're fine. However, CRA says, well, that means you're still a resident of us. You got to be a resident of something. So I have to become a resident of another place to become a non-resident of Canada. And Belize has that little hiccup there. Now, you can open an IBC, an International Business Corporation, and you could pay yourself dividends to get around all of that. But that seems like a lot of hoops to jump through for a country that is more expensive to live in than either Panama or Costa Rica. With a little bit more excitement in both of those cities. So I have looked at that. Does selling call options on a futures contract always create a better break even than selling calls on SPY because of the positive carry? Depends on how far out you go. If you're only going out 30 days, then no, it's pretty much about the same. For 30 days out, you'd be pretty much in around the same price. But if you start going out 60 days and 90 days, actually, I shouldn't say even going out 30 days. If you're going out a week, if you're doing weeklies, ES is superior. If you're doing weeklies, ES would give you a superior break even. 30 days would probably give you about the same. And if 60 days, 90 days would give you the same, unless you're going out 90 days and you switch the underlying contract. It switches from September to December. You can do better on that, because just to give you an idea of how that looks, let's say that this is SPY here. Well, given where interest rates are right now, the forward projection or the continuous line for the forward price would look something like this. So as you go out 30 days, 60 days, 90 days, 120 days, the options are priced on the forward price projection. Whereas for the futures contract, if the futures price is here, all the options are priced on that. And if the December price is up here, all the options are priced on that. So if you're going out for, the weeklies, yeah, you can do better. But the further out you go, at some point you're doing about the same. The further out you go, the less different they become, unless you, and let's say that's a September contract, that's December contract, unless you're going out to a certain point in time and you decide that I'm going to use the December as the underlying as opposed to September, then you will do better at that point. Let's see, looking at HELE movement, December spread keeps inching wider. Yes, it does. Looks like it's on the back of expected larger HE slaughter later in the year, so current lower production is expected to reverse itself, and that's the reason for the opposite moves in the front month for December. Yep, it'd been a rough few days for the trade, but I suppose nothing but an opportunity for deepening the position. Seems like the big moves in corn grain prices haven't really flowed through into HELE. No, I've noticed that too, is if we look at the price action in the grains, especially today as I'm doing this, the grains are up. All of them are up based on what happened to the ports in the Black Sea, the bombing. Wheat as it should be, corn, soybean as it should be, just based on its fundamentals. Corn's the odd one out. That it has gotten such a bid is incredible, but it has. And I'm looking at LE right now, and it is pulling back, reflecting the higher corn prices, as it should. And in the end, the consumer is the final arbiter of what the value of this stuff is. And those spreads are mean reverting. So it's a matter of the variation margin. That's the risk in this trade, is the variation margin, and the time. Is how long will it take, and how much can that variation margin work against you. And you can always just roll forward. When you roll forward, you're as you get closer, you can roll forward. You may lose some of the spread or gain some of the spread, but the spread is mean reverting. So I'm not being deterred by the spread right now. I'm not adding, but I'm not closing. It's small enough that I don't have to concern myself with it, but yeah. It has widened. Right now it's sitting at about, what do we got, 74 to 186, $1.12. I opened, I think, at $1.04. So, or hang on, I opened at, I think, $1.06. $1.04, $1.06, somewhere around there. But it is not working in my favor. However, wheat is working in my favor tremendously today. Over the last couple of days, wheat has been working in my favor. I sold the 800 puts and the 680 puts. Corn is working in my favor, although it is coming off. It was as high as 22 points up this morning. It's up 13, up 12 now. It is coming off, as it should be. Yeah. Are you planning to cover bottom-up analysis for commodities and mining? Yes, I am. Yes, I am. Could you give me a framework of how to go about analyzing these two sectors? What should I be looking at? How should I plan to break apart the micro side of things? For mining companies, it's really about what is their projection on what they expect to mine. And they'll have certain commodities that they mine. And then it is your projection of what the price would be, because their costs to get a ton of ore out of the ground are the same whether copper is $5 a pound, $4 a pound, or $3 a pound. So really, the fortunes of these companies ride on the price of the commodity. And then look at their hedging and how much of their production do they sell forward. Because in falling price environments, that would be good. In rising price environments, that would be bad. Some companies don't hedge at all. Some hedge everything, and then you have your tapering strategies of they'll hedge 30% or 50% or 70%, or they may have active hedges, which means that they do take advantage of any forecasts they happen to have. So it is a matter of looking at the commodity itself, the price of the commodity, so that when we see in the market, for example, today, looking at copper. Copper's down 0.5%. Aluminum is down 1%. If I go to the mining companies, I should see the mining companies down that are exposed to copper, and they are. Freeport is down 0.84%. If I look at the ETF for COPEX, I should expect it to be down pretty much in line. It's down 0.68. Copper's down about 0.5. What did I say it was down by? HG's down by 0.58, so that's in line. Because like I say, its income statement stays the same as prices change. What does change is the top line revenue, and hence the net income. Any price increase is pure margin, and that's why if you are bullish on any of the metals or the metal complex altogether, mining companies make a lot of sense, because any price increase goes right to their bottom line. Any sources you refer to for data? U.S. Geological Survey, and then there are industry associations for copper, for aluminum. All you have to do is just Google for an industry association. They'll usually have a .org website, and on that .org website, usually lots of educational materials and lots of learning materials. It's a matter of spending some time on these sites, and you learn incrementally. You'll learn a little bit today, then you read something more about copper or copper mining. You learn a little bit more and a little bit more, and it is a journey with no destination, because you'll never learn it all. It is just one long road that you set out on and you start going. Do you do valuations on companies you shortlist for selling puts list? Kind of, yeah. There are for selling puts on certain things. You know, you can look at some of the more common things that I think work well is institutional ownership and dividend yield. When the yield is healthy, when it is known as an income stock or an income sector, usually you'll have significant institutional support, and that support puts a floor on that stock. so that it becomes less risky to sell puts on that. Mind you, less profitable as well because the premium isn't there. But if you're looking for nice steady income with low risk, I find that a level of institutional support and a yield is nice to have. Would you consider paying up debt an interesting alternative to investing in the current irrational market? For some time I've been waiting for market correction. It does not arrive, so I'm more liquidity than I have more. Of course, I know the moment I put money in play, market will turn on me. There's always that belief. I have 5.5% 30-year mortgage. It can be paid comfortably. Oh, I see, paying on the debt. Okay, paying on debt and not paying up debt. Consider prepaying as there's no penalties. Would you consider that an entry? Well, if you prepay $1,000, you are basically you got to think about when you're paying your mortgage. You're not paying when you prepay. You're not paying the first 1,000. You're paying the last 1,000, right? So it is not as if you're just getting a 5.5% return on your money. So let's say this is the money you owe on your mortgage. This is the total sum of money on your mortgage, and you prepay. Well, you're prepaying the last amount, not the first amount. So this last amount here is 5.5%. You're saying for how many years? You're basically locking in savings of 5.5% for the next 20 years. If you have a 30-year mortgage, every time you prepay, you shorten the life of your mortgage, is what you're doing, but you still have to pay it all the way to zero. So you've actually effectively taken out that bottom amount. So you are, in essence, locking in that rate for a period of time. Now, let's say mortgage rates drop to 3%, and you've prepaid quite a bit. Right? And let's say you prepaid all of that. Well, if mortgage rates drop to 3%, what you can do is you can refinance your mortgage at a lower rate and take out a larger mortgage and get all that back. It is the same as the upside on a bond, basically. And then if mortgage rates are 3%, you could probably do better in equities, and your cost of financing is now 3%. So yeah, if you can save 5.5%, I most certainly would do it because you have a fixed rate mortgage. If you had a floating rate mortgage and you're prepaying the first amount, because as interest rates fluctuate as on the balance, you're really only paying the first $1,000, let's say, if you prepay. But with fixed rate, you prepay $1,000. It's the last $1,000 that you pay, so that if your mortgage is due here, let's say that's your last payment. Well, now this is your last payment. So you are saving 5.5% over how many years? You're locking that in. If you could buy a 30-year bond today at 5.5% interest, a coupon, a yield of 5.5, and lock it in, I can guarantee you you'd have a tough time finding one with the insurance company scooping everything they can off the market at that yield, at 5.5. So, sure. Zug in Switzerland is tax-friendly. It is tax-friendly, again, for non-residents. I must become a resident somewhere. Once you become a resident, you are taxed as if you are a resident of Switzerland. Nvidia earnings would promise 50% revenue Q over Q incoming. I really doubt they can make it. That was a final trigger for the AI rally. What if they will not deliver such growth? Do you think this can be another trigger for a sell-off? Well, I don't like betting on single events like that. I don't know that I would hold out for that as the catalyst for the downside. It would be negative. But would it be negative for Nvidia, or would it be negative for the whole sector? I don't know. I just don't know on that one. And with the behavioral action on the market today, it might be negative for 7 minutes before the market goes, we simply just don't care, because they can all see the valuation. They can all do the calculations as far as multiple of sales, market size, and even if the stock went sideways, how many years it would take before Nvidia hit 100% of the market on that kind of growth, and how long would they have to stay there just to get their money back is simply can't happen. People who are buying Nvidia today are not buying it because it represents a good value for the future. They're buying it because they believe that they can sell it to somebody else for a higher price in the near term. It is pure momentum. And momentum, when momentum breaks, it breaks hard and fast. And it usually doesn't come back. Read a Wall Street Journal article, compared the methodology of CPI in the U.S. to HICP in Europe. Yeah, I did read this about the shelter component, that if you remove that, we don't have an inflation problem whatsoever. So I compare this to a broken scale. If I'm weighing myself on a broken scale, I don't know what my weight is. But I know from day to day if my weight is higher or lower. I just, I'll step on the scale, it'll say you weigh 324 pounds. Well, I know I don't weigh 324. Next day it says you weigh 327. Well, what I can take away from that is I weigh more. And then it says, okay, now you weigh 321. Well, now I weigh less. Somebody comes in and fixes the scale, and now it reads 231. I say, holy Jesus, I lost almost 100 pounds. I didn't, right? I didn't. It's just a different scale. So CPI is a broken scale. Or you could say, no, HICP is a broken scale, not CPI. Listen, they're all broken scales, okay? The use of the broken scales is in using it consistently. What CPI tells us is that inflation is going up or inflation is going down. We measure it this way. If you suddenly just change the measurement to change the outcome, it's not comparable. Much like if I fix the scale and I say, aha, I weigh 231, I did not lose almost 100 pounds. The scale changed. I didn't lose weight. But the scale was telling me from day to day whether I was heavier or lighter. CPI tells us from month to month whether the price level is going up or the price level is going down. And if you target your policy towards the CPI, well, okay. So let's say that I target my weight to a broken scale and I say, you know what, my clothes fit really nice at 310 pounds. Well, I don't weigh 310. But what I'm saying is that when this thing tells me it's 310, that's about the right place to be. Over time, the central bank has said when CPI is about 2%, that seems to be about the right place to be. And that's what they do. Or PCE, core PCE around 2%, that's what they do. To change the scale would be, well, then what would be the target? What is the target if we change the scale? Now, if you remove the housing and CPI is already gone, well, then you face the real possibility that deflation is nearer than you think, and that deflation was here and present during the last 15 years. Because you would have to go back and remove that component from the CPI. So you need a new target if you have a new scale. Much like I would need a new weight target if I had a new scale. I can't use 310. But as long as I keep using the scale, okay, I may not know my true weight at any given time, but at least I know which direction I'm going in, and that's good enough with the CPI, I think. So AT&T hit a 29-year low. That's on their on that lead cable business, right? And the story today is, oh, it's overblown, it's too much, it's not as bad as what we think it is. Yeah, it was some event, and if you think that okay, it's not such a big deal, then okay. I don't understand enough about the communications companies to make much of a statement on that. Do you see a fundamental underpinning to a certain level of support for TLT? I've had the impression that it really have trouble pushing below 99 or 98, but that's just an eye test. I just don't see what could change that capital market 20-year yield beyond 2% inflation. The average maturity in TLT is around 25 and a half years. The majority of their holdings are greater than 20 years, are longer than 20 years. So the best proxy to that is the long bond ZB, the contract ZB. Their duration is around 17.5, 18. That's duration. That's the sensitivity. That's not the average maturity in their holdings. The weighted average maturity is 25 and a half years, almost 26 years. So they are a long bond fund. It seems the long bond has had trouble at 4%. It doesn't seem to want to get too much above 4%, and I think given where we are right now, it is possible that if money market rates go higher, it would just lead to a deeper curve inversion. I'm not saying the capital market willing to go along. So yeah, I would be comfortable. Anything under 100, I think I would be more than comfortable with TLT for a long-term play, because economies are cyclical, recessions happen, and that 30-year yield will push back down below 4%. And that will be given a duration of 17 and a half. 100 basis point drop on the 30-year bond is a 17.5% increase in the value of the bonds it holds, in the value of its portfolio. Tend to agree with your take on the yen. Yen has had incredible strength in the last week, right? U.S. side of CAD yen trade. There went on the JPY side of the CAD trade. Yet there went the yen. I'm not following that sentence, I guess. I do not see that coming. I guess I'm just not following the sentence. I tended to agree with your take on yen dollar side of the CAD yen trade, but there went the yen. I do not see that coming. Yeah, I'm not sure what you mean by there, but yet there went the yen. It honestly seems kind of sentiment driven. Nothing seriously material has emerged that should influence that big a move. Okay, so I'm not. I guess I'm going to pass on that one because I'm not following the sentence. I had a peek at our estimation of MBS spread, and it's expanded significantly over the last little while. Last week, it decreased. Yeah. Is this only an anomaly given a wild week? Probably. At what point would you start selling calls on agency? I wouldn't. I assume things would need to have turned up for several months. There's very little premium in selling calls because it is such a big dividend payer. So over the next year, it's going to pay out $1.44 in dividends. So the price would have to rise by $1.44 just to offset how much it would drop by the dividends. Do you get what I'm saying? So the calls, just there's very little premium in the calls. I wouldn't sell calls on agency unless the premiums really increased, but right now they're just not worth it. If you're into no taxes, have a peek at Monaco. Are you kidding me? I can't afford Monaco. Have a look at Monaco. Have a look at what a 300 square foot apartment in Monaco costs. 300 square feet. 300. It's the size of a living room. You're 1.5 million euro. If I wanted to get like a 2,000 square foot house in Monaco, I'm 15 million euro, 20 million euro. Now, while I could pay for that, I mean, how much does everything else cost? It is a playground for billionaires, period. If you have 100 million and you want to feel poor, move to Monaco. You will feel absolutely poor with yachts in the harbor worth more than what you're worth. I looked. Just do yourself a favor. Go on to Realtor.com and look at real estate in Monaco. It is stupid. It is absolutely stupid. It is for billionaires only. Because you would spend everything you have just to show up there. No, I don't think Monaco. I've been trying to search for this info, but I keep getting contradictory information. Is PPI the price producers pay for their input raw materials? PPI is made up of two types of indexes. It's made up of intermediate and final demand. So here is, let's put CPI here, and let's put PPI over here, and let's put a basket of goods and services in there. CPI is what consumers pay for that basket of goods and services. The important thing here is the consumer must pay for it, and it is the total amount on the bill. That means it includes tax. PPI is what the producers receive for this basket of goods, which does not receive tax, and it's what they receive regardless of who pays it. It can be the consumer or it could be somebody else who pays for it. So let's say that there is a, insurance, health insurance. If the consumer pays for their own health insurance, it's measured in CPI. If the business that they work for, if the company they work for pays for the insurance, it is in PPI but not CPI. Okay, so it is what producers are receiving. That is final demand. And then there's intermediate demand. So you have the stages. That's an S. Stage 1, 2, 3, 4. 1 sells to 2, 2 sells to 3, 3 sells to 4. So those are the input costs from stage 1 to stage 2, from stage 2 to stage 3, from stage 3 to stage 4. So there are 2 separate indexes in there. What is your opinion on tips now that real rates are on the rise? I personally have my buy-in alerts when the yields on either the 10-year or 30-year tips reach 2%. As my opinion would be a great position as a core leg of my long-term retirement portfolio. Yeah, probably. Do you have any particular yield level which you buy tips? That's not important for me. I don't have to plan for my retirement. I have that. I've achieved that level of financial success in life that retirement is no longer a problem. I don't have to think about optimizing any portfolio for retirement at all. So no, I don't. Do retained earnings include reserves as well? Well, let's make sure we share the same definition of the word reserves. I'm a corporate M&A analyst in France, and applying some of the concepts of the FRA reading has been a bit difficult because of how different non-IFRS and non-US GAAP financial well, how can they be both? If they're non-IFRS, are they not GAAP? If they're non-GAAP, are they not IFRS? I think let's take out the word non of how different IFRS and US GAAP financial statements could be presented. Translation doesn't help neither. CFA default is IFRS. The default in the CFA curriculum is IFRS. And then they'll tell you what US GAAP is. So the default will always be IFRS. Private companies here report reserves, net income, as well as retained earnings under equity. So it took me a while to figure out what the FRA reading refers to retained earnings. It really means net income plus reserves. Without seeing what you're looking at, I can't comment on this. Yeah. I currently have a position and the current price is well below my purchase price, but I've been selling calls to bring down my average price. My employer has recently placed the company on its restricted list. I'm stuck because I don't know how to get out of the position, and it sold a significant portion of my portfolio. I'm aware a single position should not make up a significant part of your portfolio, but this was done before being aware, and your company put it on a restricted list. I'm not sure if selling calls against it violates that. I don't know. I don't know. I don't know if restricted means restricted, period. What don't you understand about the word restricted? Or if restricted means that you cannot change your position on it at all. If you can continue to sell, if you've shown that you've been selling calls and you're continuing to sell calls, you might get an exemption from it. That's something you got to take up with your company. I don't know what to do on that, but I will say if you are in a position where you run the risk of this kind of thing happening, then single names probably are not viable for the type of job that you have. Considers the latest CPI read a good thing, but I think it means the Fed has already gone too far and the recession is unavoidable at this point. You know, I'm amazed on a daily basis how the market is simply not showing any signs of stress about 5 to 5.25% interest rates, and the belief is that we're going 25 in July, that you're looking at a top end of 5.5, and the market seems to be shrugging the whole thing off and saying it doesn't matter, just doesn't matter. Look at the numerator. The numerator is going to be huge. You have everybody working and everybody making a lot of money, and you have retirees now getting income. Look at the numerator, my friend. that if this is the case and the economy is resilient, the job market is strong, earnings are coming in, market is now 5% below all-time highs, here's our new neutral rate. This is neutral. We are at neutral, so neutral should not cause a recession. We have to come to that conclusion. This is the neutral rate. And if we come to that conclusion that this is the neutral rate, then the cost of capital for all companies has to be adjusted upwards, which means the present value of all those cash flows has to be lower. So that's not really a sell-off, but it's certainly not justifying where we happen to be in terms of price levels. Even if I get bullish and I say, okay, great, this is fantastic. Well, to be bullish, you must accept that this level of interest rates are inconsequential to markets. And if it's inconsequential to markets, then one of two things. It's too low, or the cost of capital is too low. Either we can go higher on the Fed funds rate without causing any grief just to make sure that inflation is gone, or this is the new neutral rate. Why lower interest rates when you have 3.5% unemployment? You're sitting, some sectors, housing, which is the most interest rate sensitive sector, housing stocks are at all-time highs. You've never made more money than being in housing stocks. We must accept that 5.25% to 5.5% is either the neutral rate or slightly below the neutral rate, but we cannot be above the neutral rate. So we are in a very peculiar position where interest rates don't seem to matter. Now, let's go to the other side of that. In Japan, interest rates didn't matter for 30 years. For 30 years. Could it be, and this is a radical idea and a radical theory, could it be that monetary policy doesn't do a damn thing? It doesn't do a damn thing. We just think it does because if you do something long enough, with a cyclical backdrop, the cycle will show up and then you can claim that you did it yourself. Much like me hopping on one foot saying, if I hop on one foot long enough, war will break out. Well, war breaks out all the time, all over the world, every year. And it has for 5,000 years. Is it me hopping on one foot that's causing it? If I can get enough people to believe it's true, then I will be watched. You know, oh, well, let's watch him. He's hopping on one foot. You know, now he's hopping on one foot faster. War. This means that war is going to happen anytime. Could it be that monetary policy is just a big freaking joke and it just doesn't work? And that there's nothing to see there, nothing to see at all? I mean, it could be. We attribute the break in inflation in the 80s to Volcker, but it happened at the same time as Reagan's supply-side economics came into the picture, and a lot of banking regulations were thrown out, trucking regulation was thrown out, airline regulation was thrown out, a whole bunch of regulations were just abolished. Pension funds could now invest in venture capital. The venture capital market exploded. Well, couldn't that have done something? Couldn't that have been the thing that got rid of inflation and not the monetary policy at all? Could that have been it? Right? So, I mean, if we're here with this level of activity and 500 basis points in 1 year hasn't budged unemployment a bit, you know, it's like getting tough in front of somebody's face and you walk right into their face and you're waving your arms and they don't blink or back up half an inch. You know it's going to be a fight. Well, they've done this and the market hasn't even flinched. When I say the market, the job market hasn't even flinched. Well, then no. This is not the neutral rate. It's going to be higher. So I don't know. I think we may have to follow a theory of saying, what if there is nothing here but smoke and mirrors? What if monetary policy is just a big joke and it doesn't work and we just think that it's doing something? Austrian economists believe that. They believe that it is foolhardy to think that you can engineer something you don't even understand. That all you're doing, all you can do is just make things worse. That the economy will take care of itself. Yeah. I don't know. It's what you think there, right? I'm putting myself in the shoes of a deranged market participant. I would be most happy when earnings appear strong and inflation appears to have reached our target range. This month's core is very promising. And I think another month will let me conclude inflation is over and happy times ahead. Never mind that a soft landing and hard landing look the same until inflation continues nosediving. Even if inflation goes to 2%. If unemployment stays at 3.5% and inflation gets to 2%, there'll be discussion around that Fed table of, hey, both mandates are done. We have full employment. We have 2%. Why would there be any change in monetary policy if that's the case? So if you're in the camp of saying inflation's going to go down to 2%, rates are going to come back down, think again. Rates are going to come back down when the economy breaks. Not when inflation breaks, when the economy breaks. And if inflation heads past 2% and heads into deflation, that is bad for company revenues all across the board, because that means that revenues are dropping fast. You'd need bigger increases in quantity just to stand still. So you can get down to 2%. You can have that nice soft landing and rates are where they're going to stay. Or you can go right past it to deflation and rates will be cut to zero, but that didn't work for Japan. I don't know if you are counting on rates dropping to justify these valuations that we can go back to where we used to be in 2020, 2019. I don't think that's going to happen. Let's see. I have never lived in Dubai to be qualified. I have several stops there, but I lived in Singapore for a long time. I assume life in both places is very similar, very metropolitan, business friendly. Let's see. Is there a question in here? Let's see. Are you sure that business visa is your only way to move there? I believe for someone like you, there must be various opportunities. It's not a business visa. You just buy property. You buy property in Dubai. You get a 10-year visa. Same with Costa Rica, Panama. You buy property. You live there for a period of time. You are just a resident. On your PPI discussion, I was thinking nominal GDP would approximate revenue growth. Yeah, well, yeah, I can see that. And PPI would approximate cost of goods sold. No, well, not quite. Not quite. I already explained CPI and PPI above, so we can move past this one. Is there a way to hedge against or avoid paying profit-eating fees when trading multiple leg option strategies such as vertical spreads, iron condors? Well, if you're with Interactive Brokers, it's not that expensive per contract. I mean, it's not that expensive. And I'm not a big fan of these strategies that have 4 legs all at one time. I've made that clear before. The strategies I step into, you always start with a call or a put, and then you let the market tell you what the next leg of your trade would be, what you're going to move into. Daily debates with friends on whether the current fiat system is more beneficial than an automated non-inflation monetary policy. Their view comes from a lack of trust in the Fed. Too much money printing and thinking smart contracts can take away the middleman and be more efficiently the board of directors, central bankers voting on overnight rates. Any thoughts on this? Well, I don't know. I seem to think that the last thing that I would want is a private company controlling this. And if you say, oh, it's all decentralized, no one controls it, well then who do I call when something goes wrong? Who's going to take care of my problem if there is ever a problem? And there will be a problem. There will be a problem. Who's going to take care of it? Who do I call? How do I get that charge reversed? And, it can't be a charge unless you authorize it. Well, good luck with that. It's technology. You don't think there's a bunch of smart people on the other side of the force, on the dark side of the force, trying to figure out how to get around all this? And it will happen. It will happen. I want somebody responsible. I trust. I mean, well, these are not evil people. This is not a third world country. This is. I don't know that there is a safer place in the world to be than in U.S. Treasuries when shit hits the fan globally. No, I think this whole idea of, lack of trust, there's an argument there. Sure, there's an argument there. But at what level of lack of trust? Oh, I don't trust the government. If you live in Canada or the US, that's a stupid statement. I don't trust the government. Well, what do you think they're going to do? Kick your door down in the middle of the night, drag you off to a camp somewhere? I mean, this is not North Korea or even parts of China per se. So to say something like, I don't trust the government, you're lucky you live in a country which gives you the luxury of vocally saying out loud you don't trust the government, because in some countries, if you say that, you're going away. There's where you don't trust the government. But come on, man. If you don't trust these governments, there is no government system in the world you will trust. There is none that you will trust if you don't trust these systems. Now, do things happen that we're not aware of? Yeah, they kind of have to, right? Then we probably don't want to know a whole bunch of truths. There's some things we'd rather just not know, and that's fine. But I have no issue with the currency. I've been in Canada since I was born. I've lived in the US, and I've held on to dollars in both countries. And yeah, for the most part, no, not for the most part, for all the part, I haven't once looked at my money and said, oh my God, I need to spend this right now and put it in real assets because this is happening or that. Never once. And that they are inflation hawks the way they are, great. So yeah, I think that's a lot of, thinking that the future is going to be great because the present sucks, and all we have to do is just do something different. At any point in time, at any point in history, no matter what newspaper you open, pick a year, pick a day, pick a time, and it's full of, oh my God, it's never been worse. Look at all the political issues in the world today. Go back to 1962, same thing. 74, same thing. 79, same thing. 82, same thing. 87, same thing. 91, same thing. Get where I'm going? I don't know that there's ever been a day where you haven't looked around and said, look at all the problems. So yeah, I don't, a good example is this, is we got to get to Mars. We got to get to Mars. We have to start moving to another planet. We've ruined this one. Yeah, but this place has air and water. Mars doesn't. We're miles ahead of Mars already. So it sounds great. Yeah, we got to get to Mars, And it's easy to shit all over the Earth, but when you get to Mars, what you going to do? There's no water. There's no air. There's no plants, there's no trees, there's no food, there's no toilets, there's no internet, there are no movie theaters, there are no beaches, there's no clubs, there's nothing. So this idea that we can change a whole planet and make it better, and it'll be so much better, and everything's going to work out, and it's going to be great, and it's going to be fantastic, there'll be no downside. Give your head a shake, man. If you put humans in the mix, downside will happen, because you'll have a distribution of outcomes, and let's think about our distribution, right? Let's think normally here. Whenever you get humans involved, you're going to have a distribution of outcomes. There's the left tail. You will always have the left tail. Always. So if you say, well, there's this and there's that, and there's this and there's that, and there's this and there's that, look how bad everything is. Yeah. If you look in the left tail, you'll always have the left tail. No matter what system you have, you'll always have the left tail. All you can do is design a system that minimizes the left tail. North Korea's left tail looks like that. There's the right tail, and only if you're part of specific families. Everything else is left tail. So you want to try to find a country where the left tail is as far in the left as possible. And if you're pissing and shitting all over the UK, Germany, Canada, United States, find me another country that has a left tail as far in the left tail as those countries overall, right? Much like find me a planet that can replace Earth right now. What is your approach to Canadian companies for TFSA? Basically, just for the TFSA, you have to hold Canadian companies and fairly safe Canadian companies. So I have apartment REITs in there. I have I don't know what else I have in there. It's such a small account. Like it's overall it's small because you can only contribute 6,500 a year to it. So it's I think I just have apartment REITs and that's it. And you know nothing much else in there. What are your thoughts on taking the SIE? Oh, I think somebody already answered you. I'll let them take care of that. Do you expect the energy sector to outperform the market over the next few years? Um, Outperform the market, that's a tough one. It's a sector in the S&P. It's a small sector. I think it makes up 4% of the S&P. Its forward earnings multiple, I think, is the lowest in the S&P as well, along with the highest dividend yield. So you have a fairly cheap sector with a fairly low forward earnings with a very high dividend yield. And if you look at the cash flow yields of these companies, it is in some cases 3 to 4 times that dividend yield. And that cash flow yield, what we don't see in the dividend yield is the share buybacks. You only see it in the price. So given the low level of exploratory capex, the fairly low, well, the non-existent capex for exploration, the very low maintenance capex, these are cash cows right now. So I don't know that they're growth industries as much as they're cash cows. So if you're looking for a great river of cash, then yeah, I think energy is the way to go. Outperform. I guess if you look at it on a total return basis, I don't think it can outgrow the S&P in terms of the growth of the industry, but outperform on a total return basis, with including mostly with the energy sector, would be the income yield, the dividend and the share buybacks combined. Yeah, I think you have a good chance of doing probably better if you were all in energy than in S&P, but don't look for these big price gains. You're looking at your return in terms of cash flow, and then the reinvesting of that cash flow, I think, can do quite well. Can we join Market Series 1 month later? Yeah. The principles are the same, even though the market data I would be using is specific to the day I'm using it. The principles would be the same. Let's see. On your website, you have a link to Benjamin Felix. Common Sense Investing is also one of the hosts of the Rational Reminder podcast. Let's see. Okay, that's just a comment. Another podcast I listen to is Saxo Market Call, Daily Market Insight across all asset classes. Okay. All right, so those are just comments. Let's see. Which order should you go through the applied series videos? I don't think an order would matter for that. I've been asked that and I've thought about it, and I don't really think an order really matters. Is holding your USFR HYSA? I didn't. I don't know much about these two in terms of state or local tax. I'm not a U.S. taxable person. Let's see. It sure looks like shrinking corporate spreads are buoying IYR unless the average participant doesn't look at that at all. Yeah, IYR has been a tough trade as well. Anything short, it seems, has been just a tough trade. However, I am long PLD, and I did buy more yesterday. PLD had great earnings and it was up in pre-market, then went all the way down to 120. From 129 in pre-market, 130, all the way down to 120. So I looked at its results. The only real issue I could see was the retention rate dropping for 3 quarters in a row. That the retention rates are dropping, and there is a background idea that there is fewer and fewer. I shouldn't say fewer and fewer customers, but that fewer and fewer long-term customers when you have a retention rate that's dropping. But I mean, they recovered nicely by the end of the day, and they're up again today. At least I think they're up today. Where's PLD? PLD is only up 10 cents. They were up a couple of bucks in the morning. Now they're only up 10 cents, sitting just a little under 125. So I do have REITs. I am short the IYR, but I do have some REITs that are outside of office and retail. Thank God. So, not making, not losing. I don't know what to do with that one. At some point, when we come to terms with everything is fine, well then there's no need to lower rates. Once we come to terms with higher for longer, which I don't think the REIT sector has really gotten that yet, those cap rates have to go up. And if those cap rates go up, those valuations have to come down. Well, I shouldn't say valuations, those prices have to come down. Looking to Dubai, absolutely wonderful place to live. Recently came out 10% tax on anyone that was over 375. Previous was zero due to oil. I think that is on income earned within that country. Dubai beneficiary of capital flight from other parts of the world which can't offer the same quality of life. Formerly have no taxes. Hidden 4%, which you pay when you buy a property. Yeah, but that's a one-time deal. That's not a big thing. In Canada, we have, I think it's like 1% on land transfer tax that we have to pay, 1 to 1.2%, something like that. Being a Dubai resident means 30% tax on dividends received in the U.S., 0% on capital gains. Yeah. Some things you can't avoid. You can get an investor visa. Yeah, I knew all that. Let's see. Can you show us how to day trade options? Well, buy it and sell it in the same day. I don't know. Like when you say how to day trade options, a day trade just means it's for the day. So you'll open a position and you'll close it the same day. That's it. But that's a juvenile answer, right? I think what you mean is, can I tell you what to sell it on or what to buy it on and what time to do it and what indicators to look at and when to do it? Well, if I could write an algorithm for that and it would be done, and then I just make you pay a subscription to the algorithm. So day trading is just gambling. It's roll the dice and see what you get. So, a day trade is just you open and close the same day, and then you go ahead and figure out what you want to gamble on. I don't really do that. There's a YouTube channel called Nomad Capitalist. I am aware of this company, Nomad. Super expensive, and in the end they farm everything out. It's really easy to get this done. You need a lawyer in the country you're going to. You need an accountant in the country you're leaving. That's it. Used car inflation going down from 4.4% month over month in April and May, and for it to go down 0.5 seems like a significant drop. What could be the driver of such a large drop? Inventories are building. And if you are looking for new vehicles, there is more selection now. So you can actually get something. It's not, last summer when I went to look at vehicles, you're being told it was a 2-year wait for anything that you wanted, anything decent that you wanted. That's going away. You should 100% get with a consultation with Nomad Capitalist. They want $75,000 US for something I can get done for $7,500. For less than 10 grand, I can get it done for less than 10 grand. They want 75,000, and in the end, they farm everything out to the local people, anyways, that you would normally go to on your own. I've already had the lowdown on that group. Considering the influx of migrants into Canada, landlords feel comfortable passing the interest cost to their tenants. Yeah, that is what's happening. I live in Dubai and be happy to give my 2 cents in the landscape. I'll be there in October. What am I missing here? If inflation is lower than expected, the market rises because it's assumed that the Fed will stop increasing rates and can maybe even start decreasing them. Well, take out that part. If inflation is higher than expected, the market rises because it's assumed the economy will break and the Fed won't have any option but to lower rates. Pretty much. When you can make a bullish case out of absolutely every piece of data that comes out, you are in a market that is more behavioral than anything else. And this is a momentum-based market that is behavioral, and every argument is going to be bullish. Every argument will be bullish. Every data point will be bullish because, Is there any research that attempts to understand why the economy doesn't always have a recession when the 2 to the 10-year curve is inverted? I don't know so much about research that shows why it doesn't always have a recession. Typically, the 2 to the 10 will invert first. And usually when that inverts, it means you're going to move into a lower growth environment. So you can go from a high growth to low growth environment. In a low growth environment, you usually also get the 3-month and the 10-year inverting, signaling that we're about to go into a lower growth environment, which usually brings it negative. So if you get the 2 to the 10 inverting, it just means that you'll go from high growth to low growth, but then something may happen and then you go back into high growth. So you may not always get a recession. Plus, those are the capital market curves. The more important one is the money market to capital market curves, because if you have an inversion there, that makes it challenging for banks, and it really squeezes credit because the incremental funding cost for banks are at the money market end of the curve, whereas the rates for lending, the capital market curves, being that they're inverted, bank has to engineer an upward sloping curve. If money market rates are high, then their 10-year loans have to be even higher, and that usually constricts credit rather quickly. I don't think that's the bullish argument. Haha. Okay, I don't know why that's funny. I don't think that's the bullish argument. Haha. I see a lot of people use the haha a lot, or LOL, for common everyday things. You could text somebody, where are you now? I'm on my way. Haha. What's so funny about that? I'm on my way. Haha. Like, why even type in the haha? Wasn't that just a waste of time? Or they'll say something rather straightforward. News is on at 6. Haha. My show's on at 9. LOL. I don't get that. I guess it's just how Canadians put A at the end of each word, eh? Haha. I don't know. It's soft landing, and it's only the top 7 companies that are slightly overvalued. The rest of the market is fair value. Only top companies are slightly overvalued. See, this is a person convincing themselves that everything is that this is the behavioral aspect. Only the top 7 that are slightly overvalued. NASDAQ 100 has a trailing PE of 40 times. 40 times. It's not slightly overvalued, it's overvalued. The S&P market as a whole, the index as a whole, has a forward earnings all in of almost 22 times. That is not slightly overvalued. That is not the rest of the market at fair value. That is a market. The S&P 500 is a market. That is a market that is overvalued. There are some parts of the market that are fairly valued, yes. But to say that the 7 are slightly overvalued, that Amazon at over 100 times earnings is slightly overvalued, that Nvidia at what multiple of sales are they at now are slightly overvalued, that Tesla pushing almost 50 times forward earnings with we know our shrinking margins is slightly overvalued. These are not slightly overvalued companies. So but this is how we convince ourselves that there's a bullish argument, by saying the top 7 companies are not overvalued. Let's throw an adverb in there, slightly. Oh, it's only slightly. And then the rest of the market, let's just call it fair value without really seeing if it is fair value. When you talk about the rest of the market, communications has a huge multiple. Consumer discretionary has a huge forward multiple. The whole tech sector has a huge forward multiple. No. You mentioned you listen to All In podcasts. How do you feel about the discussion of the probability of soft landing increasing in recent weeks? Well, everybody is saying that the probability is increasing in recent weeks, so I think they're just echoing what the market is doing. If the market is going up, well, the probability of soft landing is increasing. But you still have leading indicators pointing down. You still have curve inversions that are both deep and have been around for quite some time. So when you look at the economic fundamentals, they have not been changing. The backdrop has not been changing. Only the stock market has been going up because of multiple expansion. So that on its own can change a whole bunch of people's opinions. Oh, prices are going up, we're going to have a soft landing. The stock market is not the economy, they like to point out. when it makes the case the other way. Stock market's not the economy. Well, I'd point out the same thing. The stock market's not the economy. You can't look at the stock market and say the economy will have a soft landing. Much like you can't look at a bear market in the equities and say, oh, the economy's headed down. Stock market's not the economy. Economy's just fine. But somehow a rising market means, oh no, the stock market is the economy. You're going to have a soft landing. I don't know that you can do that. I mean, if the economy and the stock market are not the same thing, then you cannot say rising prices on the stock market mean a soft landing. What do you think of buying long-dated puts on Nvidia? Nah, that's just gambling. It's something I don't like doing. What's the likelihood of the rolling recessions theory? Last year, real estate and tech saw notable layoffs. Earnings decline and depressed valuations. I don't know that they saw earnings declines. Housing never saw earnings declines. Goods sector always faced major headwinds with an inventory buildup leading layoffs. Okay, well, that's just a long justification for rolling recessions theory. Well, it is out there. It is a theory. I don't know. It sounds interesting, right? The rolling recession that's just going to roll through certain sectors of the economy. But if it's just rolling through certain sectors of the economy and then that sector then improves and another sector turns down, as the other one's improving, does it not add to inflationary pressure? Right? So it's not as if we get through housing and then now inflation's gone out of the housing sector altogether, then we get to the next sector and a recession rolls through that sector and then inflation's gone in that sector altogether. It's not like it'll happen in that particular way. It'll go through housing and then housing will rebound and inflationary pressures will come right back in housing as it goes to the next one. So it's not as if the recession can take care of one sector at a time and fix everything in that sector. Say, okay, there, inflationary pressure in that sector's gone. Let's move on to the next sector. It doesn't work that way. So, while it sounds like a neat idea, if you really think it through, I don't see that you're going to have this rollout of inflation across sectors. We look at housing. The recent data in housing is pointing to prices going back up. So no, I don't know. I don't know about that. Every so often you have the buzzwords of the market, the catchwords of the market, and they seem to catch on, and they have a story and a narrative, and they become part of the narrative until they're no longer part of the narrative, and we all say, oh, it is what it was the last time and the last time and the last time and the last time. It really isn't different this time, right? The most dangerous words, this time is different. Does Bullard stepping down have any bearing on future Fed action? I don't know. I don't know until we see who replaces him. Where does he talk about the thing he has been noticing in firms' 10Qs? I think that was last week. Yeah, that was last week. And that's it. We're done for this week.